Today, ladies and gentlemen, I'm going to share with you this profound idea with a Canadian dividend stock that had you invested in it only 20 years ago. I know only 20 years ago, but the dividend today would be over doubling your initial investment every single year, and the stock value itself has dramatically outperformed the S&P 500 in the exact same time period. Now, could this perpetuate into the future, replicating the same in the next 20 years? I don't know, but I think it's so important to point out that this profound idea is something that anybody can take advantage of as a new investor, because we know you need millions of dollars to invest to retire off dividends, but I don't want you to think of it that way. I want you to think like I did when I first started investing, just to get you started, that if you put $10,000, let's say in a telecom giant here in Canada that yields, say, 5% on the dividend, that $10,000 would make you $500 a year. If your phone bill is only $40 or $45 a month like mine is, that would basically cover your entire phone bill in perpetuity for the rest of your life. And that's a pretty good trade-off for $10,000, knowing that even if you use the dividend, the stock value should still go up over time. It's like that Kevin O'Leary dream saying from his mother's olden time investing philosophy, which is you want to get paid while you wait for equity growth. But let's get into this, because I don't think people truly appreciate the initial idea of compound interest growth. Now, obviously, a lot of people in this market are chasing these super, fast money kind of small cap stocks, and a lot of them have lost their shirt in the last couple years. And obviously, I think it's proponently important to make money off growth and dividends. I've done that with my portfolio, and I'm always focusing on these two kind of investments. But if you put a measly $15,000 into a 5% yielding stock that, let's say, can grow at 10%, including the dividend on a year, you're reinvesting the dividends, that'd be $750 annually over a 20-year period. That could balloon into a whopping $150,000. Now, imagine if that was $1 million or even $100,000. I mean, you could start seeing how if you're 20 years old, you could quickly have a retirement by the time you're 40, or even if you're 30 years old, this would take you into your 50s. But the stock we're obviously talking about today is Telus Corporation. It is by far one of my favorite Canadian dividend stocks of all time. And we're going all the way back to 2003, which is mind-blowing that, I'm 30 years old and I can remember back in this time. I'm starting to feel old. But we can see that during this time period, that if you bought that 20-year price period, you would be up 532% just on the stock gain value alone. To put that in perspective, the SPY, this S&P 500 ETF, is only up 377% in the same time period. And if we look at the dividend growth that Telus has offered from 2003, it was paying out 0.04 cents, and today it's paying out 36 cents. That's 9 times the value. That means you'd almost be doubling your money every single year, pretty much just off the dividends, which is, insane. It's just mind-blowing to see what long-term effects can have if you can buy foundational companies like this. Now, obviously, I think it's safer to be buying ETFs, but, picking a few companies like this and can really profoundly change your long-term growth on your portfolio. It kind of reminds me of Apple when I started buying Apple several years ago, and my initial yield on cost was like 5%, and it was mind-blowing. But I sold it at the end of last year, and I primarily put that money in an S&P 500 ETF. Be doing pretty good if I just held on to it at this point. I mean, Apple's pushing back toward its all-time highs. But let's talk about Telus and just some of the news that came out on their recent earnings, because these numbers are astounding, and it's something that I keep telling you guys. The Canadian economy is one of the fastest growing economies on the planet. I think these telecom giants, because they're monopolistic, there's only a handful of them, they're going to benefit just insanely well from the growing economy. So just take a look at this. Total mobile and fixed customer growth for Telus was 163,000, up 15,000 over last year, and our strongest first quarter on record, driven by strong demand for our leading portfolio across mobility and fixed services. The strong phone net additions of 47,000 are their best quarter since 2010. Their record first quarter fixed customer net additions of 58,000, including 35,000 internet customer additions, powered by industry-leading customer loyalty with blended pure fiber churn below 1%. And the combination with Telus Pure Fiber Network achieved 1 million security customer milestone. These numbers are absolutely insane. And their dividend, they just raised it to 0.3636, an increase of 7.4%. An astounding dividend growth rate here, guys. And getting into it, a lot of people have confusion around these telecom giants because they're very capital intensive companies. And if we just take a look, first and foremost, we'll take a look at some of the growth here because it's pretty astounding across all their networks. I mean, first off, mobile network revenue was up 7.6%, mobile equipment and other service revenue up 17%. Fixed data was up 6.7%. Fixed voice services were down slightly. Pretty much the only area where they saw a slight decline. They got fixed equipment and other service revenue was up 13%. And their health and services segment that's just starting to take off is growing, but I think that was more or less from acquisition-based growth. But nonetheless, what a lot of people have concerns with is the net income. And there's a few things on here that I find a little confusing, so I'm going to try and simplify it for you because net income has actually been dropping pretty dramatically, which is a little bit concerning. We can see their basic earnings per share have been dropping pretty dramatically to 15 cents. Adjusted basic earnings were 27 cents, yet their dividend is 35.11, and they just increased that, right? So how are they increasing a dividend that they can't afford off their basic earnings? Well, this is a convoluted thing that comes with heavy infrastructure-based companies, the REITs, anything that is like really infrastructure-based. You're never going to truly understand the earnings per share. It's kind of a pointless metric to try and wrap your head around, because when we look at Telus, you can see it trades for a price to earnings of 26, which really isn't accurate because a PE multiple is driven from the EPS numbers. And to figure this out, we have to come back into this earnings release because they say strong quarterly financial results, including consolidated operating revenue and adjusted EBITDA growth of 16% and 11% respectively, and double-digit free cash flow growth of 29%, but net income was lower by 45% on higher interest, depreciation and amortization, and restructuring and other costs. So let's talk about what's eating up that net income. And we can kind of see where people get fearful of the dividend, because if you come into Yahoo Finance, where people lazily will scroll into and they think their payout ratio is 135%, which is obviously unsustainable, but the term amortization and depreciation of assets is a big player in how they can actually afford the dividend, because they wrote off almost $1 billion. What does that mean, wrote off? Well, imagine you bought a brand new car to go to work. You know that car, the day you drive it off the lot, is probably going to lose 15 to 30% of its value immediately. But that car is still going to be generating you the same amount of revenue taking you to work. Yet these companies are able to write off that infrastructure they own like they would a car. That infrastructure still generates the same amount of revenue, but they can write the lost value of that infrastructure against the income. So they're not losing the income, they're just writing it off as a tax benefit, right? And they wrote off $1 billion. So that's a huge piece of the pie here that kind of just doesn't get taken into consideration. There's a lot of other concerns that I have here that I really want to pay attention to in this interest rate environment, and that is their interest debt, right? We can see their debt is kind of ballooning a bit here because their financing cost increased by 141 million, and the interest expense increased by 123 million. And we can see the interest on their long-term debt went up by like 55%. Obviously, you know, as they have to restructure these costs, whether they were using variable rate debt, floating, you know, lines of credit, we're going to eventually start seeing that impact their cash flow. But luckily, the growth this company is experiencing is being cushioned by that. So it's nice to know that, you know, they're in a relatively reasonably robust situation. And if we even take a look at the financials, we can see that these infrastructure companies do come with a little bit more debt-heavy liabilities. So 54 billion in assets against about 36 billion in liabilities. So we should see the debt continue to hinder some of the growth. But again, the company is growing at such an astounding rate that it should be making up for any of the interest rates. Like I said, I don't mind paying a bit more in interest, but the company has to be growing. And that's a fear with a lot of REITs, because real estate investment trusts in a market environment like this might have more trouble growing than, say, something like an infrastructure company like Telus. So I think Telus probably a bit more sustainable. And considering it's a dividend and not a distribution like you get from a REIT, you do get a dividend tax credit, which means you do get lower taxes on the dividends you would receive. So I'll pass the question off to you. I'd love to know what you think about them in that comment section below. If there was something I missed in the numbers here, how do you think about their long-term growth rates? Do you think they can do what they did over the last 20 years and replicate that into the future? I'd love to hear about all of that down below.